Welcome everybody to the SoFi Weekly. Very exciting show for you guys this week because the Fed lowered interest rates.
Rate cuts are in, ladies and gentlemen. How do you think Noto's feeling right about now?
Vindicated. He got 50. I thought 50 was warranted, but I thought the Fed would give 25 just because it's the Fed. And so I was pleasantly surprised. And the nice thing is we saw the initial reaction from the market. Very excited, and then it kind of sold off that day. And then the next day, of course, is one of the best days to be in the market. It just kind of goes to show you it's just better to be in the market if you're in quality companies long term, because it's hard to predict that day by day movement.
He wanted 75 basis point cuts before starting 2025. So it's looking like we might actually get above that at about 100 basis points by the end of the year.
I think we're pretty much guaranteed at least 100. If nothing changes, like if things continue to go the way they have been, where inflation kind of stays down and is kind of slowly trending down. And so it's going to take at least a little while for unemployment to flatten out, which is what they're hoping for, right? To nail the soft landing. But based on the comments that Powell made, like he was as dovish as I think you could get. But the fact that they cut 50 to start, I think was the right move. I think they should have cut 25 in July. And I think after getting that data, that most of them felt the same way, and that's probably why they cut 50 this time.
So there's two more Fed meetings between now and the end of the year, basically looking at between a 25 and a 50. These shift around quite a bit. You can see how much change happens. People are projecting 50 versus 25. Looking at the end of the year, we can see where they're expecting rates to be. Right now, consensus is right around the 400 to 425. So that's giving Anthony Noto exactly what he was wanting. Since they did the 50 basis points, it gives them some flexibility so they can kind of look and see how things are progressing.
I'm with you guys that the range is sort of between 75 to 125 bips. To end up at a 75 would mean that one of the meetings, they don't do anything. They just pause and then they cut 25 basis points the second meeting. The base case is essentially 25 for the remaining two meetings and we end up at 100. Or if there's 50 and 25, then we end up at 125 for the end of the year. I found it really interesting. I don't know if you guys had a chance to check it out. FedEx reported earnings and they were like drastically lower. How does this relate to this? Is because Alan Greenspan using FedEx as a bellwether for the economy, essentially, how many packages were being shipped, so on and so forth, to determine the strength of the underlying economy. And if a company like FedEx is massively missing their numbers, obviously that's going to perk up some ears around, okay, how strong is that consumer, which could then lead to the Fed adjusting their decision.
I think that there's a little bit of smoke there. It doesn't mean that things are burning. A lot of macro people are like, yeah, recession's coming. And they've been saying that for like 2.5, 3 years. Could happen. And even then, I think SoFi will be just fine because Noto is pretty conservative with its investment strategy. That's one of the reasons why lending was slower this year.
I think that we did in some ways have kind of a rolling recession. A lot of the industrial stuff kind of ground to a halt. SaaS also went down to like all-time low multiples. It's recovered since then to a degree, right? But SaaS actually had a pretty big drop in terms of growth rate. And then obviously financials got hit in like March, because of the rising rates and commercial real estate and everything else. So it seems like in a lot of ways, we've actually hit a lot of things that were indicative of the fact that the economy did slow down in a lot of different ways. It seems like things have normalized a little bit.
The thing that gives me pause is the fact that the changes that the Fed is making right now won't be felt to the underlying consumer for such a long time. For consumers who are holding out, let's say, who are saying, okay, let me brace the storm, the tough time is going to pass, they're going to be waiting for longer than they probably expect to be waiting because of the lag in terms of rate cuts and how long they take to get to the end consumer. And so during that limbo period is what I'm really worried about, because it might seem as though the Fed is doing everything right to be able to fix the economy and get us to that soft landing. And then things might break as that lag time goes on over the next couple of months, over the next couple of quarters, because by the time the consumer actually feels the rate cuts, it's going to be like a year from now.
Yeah. Like, why is it actually bullish that they're cutting for SoFi?
My whole thing is that it's duly beneficial. From one side, you have why it's beneficial for the stock. As rates fall, what you get from treasuries is going to fall. So more money is going to flow into equities and there's going to be essentially more buyers, and that's going to drive the price up. And then on the SoFi specific side, it helps from originations perspective with student loans and home loans respectively. And that's in the entirety of SoFi's business that they've sort of been building in the background with the acquisition of Wyndham, with now the moratorium being over. I think that's really going to help accelerate SoFi's growth rate, accelerate their financial situation in general, accelerate how much money trickles down to the actual bottom line, and it's going to make them look much better from a valuation perspective if their stock price stays relatively the same.
Their most popular financial services product right now, SoFi Money, is going to have a hard time during this time with their interest income lowering if rates come down.
I think that's a red herring.
Case
It's all about the spread, right? The revenue, right, is the difference between what they give out to their members and what they charge the lending segment, or what the lending segment lends from them at, right? There's some sort of spread in there. They've said that they want to keep it higher for longer. We'll see how much they actually do. I would expect them to probably cut the APY in the next couple of weeks. If they don't, that'd be really interesting. The loans that they currently have on the book that they're going to keep, the ones that they already have, the 20 odd million amount of loans on the book, those aren't going to just drop off immediately. Most banks, as rates come down, they can lower their APY faster than their book runs off. SoFi has this existing book that's at, call it 13% for personal loans, and the student loan APRs are actually higher now than the book is, so that the student loan APRs are going to continue to expand. I actually think that overall net interest margin, which is what you actually care about, right? How much you allocate to the lending segment versus how much you allocate to the financial services segment, doesn't matter that much to me, but the overall net interest margin, so the amount they make, I think will expand further, not only because they're going to lower cost capital, but also because that existing book is going to stay high. As rates were going up, SoFi was able to expand their net interest margin on the products, or at least keep level with their rising cost of capital. That's not what other lenders saw. So specifically, Lending Club is the one that I'm talking about. So Lending Club, in their personal loans, their net interest margin dropped a ton during that same time. And their CEO, he explained it. He said that essentially what happens for them is that the Fed will move their rate up 4.5% to 5%. A month or so later, credit cards will follow. So credit cards would go from, say, 22% to 22.75%. And only once people saw their credit card rate going up would Lending Club then be able to move their rates up. And so he basically said that there was like a 3 or 4 month lag between the Fed moving rates and Lending Club being able to move its personal loan. But SoFi actually did the opposite. So SoFi's personal loans went up faster than the Fed funds rate. I think that the reason why is the fact that they've got a ton of members that are coming on board every single quarter, and all of those members that are coming on board expands the pool of borrowers that are applying for loans for SoFi. And so if you're expanding your pool of borrowers by 40%, you can raise your rates faster and still get as many originations. And so I do think that on the way back down, I think that they can stay high on originations and keep the amounts that they're charging on their loans higher, because SoFi's member count is even expanding faster now than it was back then. I think that net interest margins are going to expand, but we'll see.
SoFi announced a reverse stock split for the SoFi Select 500 ETF. Why would this even need to be the case?
It doesn't make sense.
It's pretty low. Price of it, I think, is around the 20s. I own some, but the stock price is 20. I have to assume that they think it'll increase the liquidity or increase the assets in their management for some reason. If it's trading at, call it 100 or something, it'll look more expensive. So it'll go from, it's a 5 to 1, right? So it'll go from like $20 a share to like $100 a share.
Yeah, it's a reverse stock split. It's not a stock split. So it'll look more expensive.
It's the first time I'm hearing about this. I'm trying to understand the logic. I wonder if it's anything to do with like management fees, or anything to do with like the amount of shares outstanding, like the float overall from like a liquidity perspective, or like something technical is where my mind is going as to why they would do this.
I also don't think it has a negative effect either, other than the fact of maybe it stops newer investors from getting in, but I'm sure it might lower their management cost. Maybe they're paying based on the amount of shares that are flowing through the system. On the actual administrative side, I've got no background at all. Do you have expectations for where this gain on sale margin on their personal loan side, for example, is going to go? Like, how high can this get? What was it historically back whenever rates were at 0%?
So this is personal loan gain on sale margin. So gain on sale margin means like if I'm SoFi and I have $100 of loans from somebody and I sell them to somebody else who's buying the loans for me, the gain on sale margin is the amount above principal that I'm selling them for. And so you can kind of see at the bottom, second quarter 2022 is when we started getting rate cuts in earnest. And so the gain on sale margin was right around 4%, call it 4.5%. And then once rates paused, and now going into the future, the gain on sale margin has actually gone up quite a bit, as you can see here. So it's up at around 6%, which is really, really high. So SoFi does hedge their loans to make sure that like if rates go up or if rates go down, they can still get the same amount. As the forward curve has moved downward, it seems like there's a lot more demand demand coming into the marketplace, and that's why they're able to command higher gain on sale margin. Now, I don't know where these numbers could go, but this is a positive trend that I'm happy about. Student loans, they haven't sold that many, but they've been pretty much flat at 4% forever. But you can see there's a bunch of quarters that got skipped in here, right? So they sold absolutely no student loans in third quarter, fourth quarter, first quarter of like 22, 23. And then there was another big gap until the last quarter as well.
So there isn't some sort of benchmark or any data that we know of where we could get to 108, 110.
If they had stopped hedging their loans, call it in October, right, when the 10-year was at 5%, you could probably easily get up that high, because you'd be getting these huge tailwinds from rates coming down. In one of the calls that I had with Chris Lapointe at one point, I said, if it's obvious that rates are coming down, would you choose to not hedge your loans? He said, no, we will keep our hedges on no matter what, is kind of what he told me. I don't think we're going to get up to 108 or 8% or 10% or whatever it is.
Ladies and gentlemen, Matt Flo, are you able to talk about who you are and what potentially you do?
I'm retired from a few different backgrounds, airlines and finance. I do a few things on the side. I do have access to SoFi headquarters on occasion. They have a team of us who look at the future products. They ask us about different things and they tell us what direction they're going. There's a few things coming out that I've had direct access with, where we're broken into teams with the IT departments and we tell them what sucks, which is a lot. And then they go ahead and put those on their boards to try and fix them.
Can I ask why you're trying to help SoFi along its journey? What's the meaning here?
For me, it was actually kind of interesting. I started investing in SoFi. I think it was at $14. Just on a whim, I bought some stock at about $14. The reason I had done that was I just bought a property that I was going to build a house on in Lake Tahoe for $375,000. So I put another $375,000 into SoFi to double it. The stock quickly went to 24 and I was being greedy. I was like, nope, I'm not at double. And it never saw 24 again. So as it started coming down, I started to study what I had actually done. And I started to study this company just like you guys. It just got better and better. So I fell in love with the company. I started moving my accounts to SoFi. At one point I had moved about, maybe say $1 million into a vest. And I get this phone call from SoFi. It's the Invest group, and they want to know what they can do to make it better. And I started giving them some things that I wanted, and they continued to push back and say they couldn't do it. But it was always on the list. It kept dropping. I kept buying more, and the Invest people called me back and said, we have this board of directors that you can join. They recommended it. They said there's about 10,000 people that have applied, and we take about 12. I applied to that, interviewed, and I was put on that board. Out of the 12, I'm probably 11th dumbest. These are really smart people. I was lucky enough to get on there. I just kept buying all the way down to the 6s, 5s, 4s. So, my cost average isn't that great. It's, maybe 775. But I still have about just over 508,000 shares.
What products have you, if you're able to say, been testing that have really surprised you on the positive side?
There's just a couple of new things coming out. They're really working on adding products for financial education, which we appreciate, but there's a few of us, we really get into the head of Invest. He catches quite a bit of crap from us. They know they have to do a lot of work there. So we've been working on that a lot. Even something just as simple as transfers. This last week we were working on, it takes 7 clicks to transfer from your savings to your checking. We wanted to get that down to 2. We were working on how we can get that done, where we can add new buttons to work on making the platform work more smoothly.
Are they just looking out for the individual, or are they also looking out for the small business? Is there any insight?
Well, 2 things. So we get on them quite a bit. I think the next thing is that they're working on is if you have a credit card right now and you add your spouse onto that credit card, your spouse can't even see what's going on the other side. So right now the joint accounts, that's probably the next step. We're working on some of that and getting the joint accounts going. They didn't really talk a lot about the business side. I know it's important.
And they might have their own focus group of small businesses that they're asking questions about. So who knows?
You're right. I think you're right. Yeah.
Matt, I thought I saw somewhere that you had the beta for Cash Coach. How should we be thinking about this? Is this, one of those education features that's going to end up being a nothing burger, or is it a piece in a wider vision? Because when Anthony Noto was talking about it in the Goldman Sachs thing, he was talking about the whole concept of products on top of products. To me, it sounded more like a feature, but curious to get your take after having used it for a while.
The funny thing when you say Cash Coach, even everybody in the office still calls Relay. Cash Coach is more of an AI product. It's not as simple as everyone thinks. It's not an if-then product. It looks at every account that you hook to Relay. It looks at your spending patterns. So when you open your vaults, you can set goals. And what we were talking about a couple weeks ago was we're going to add some features to the vaults. So you can say, I want to go to, and in this case, they said, I want to go to Bali. Well, how much does that cost? And when are you going to go? And then you put in those parameters. Then Cash Coach at the end of the month, it'll say you have $1,800 left. So we suggest it'll break it out into $1,000 into your emergency fund. You need to put $600 into your Bali account, and then you need to pay down this credit card with the remaining $200. It looks at the whole Relay experience, and it will figure out percentage rates on cards, the goals that you have set, and where you want to be. And then it will make suggestions on that discretionary income that's left over at the end of the month.
So I didn't know the AI piece, and I think that AI piece is really crucial to understanding the impact of this thing. To me, it sounds as though this could be the core of a wider shift in terms of how people leverage SoFi's technology. Like if I have an AI that's continuously training on my data, my goals, what I want to achieve, what my income is, what my expenses are, extrapolate that over time, multiply that by the entire user base, then you can come out with something that's really powerful that can totally change the dynamic for how people interact with their financial institution. Like, is that the long-term vision, or we're just not there yet? This is just something we're playing around with.
Oh, no, absolutely. That's their vision. This is one of their big products that they're really looking forward to, because back when SoFi was just doing student loans, the first thing they came out with was Relay. That kind of was a precursor to the direction that they wanted to go. Cash Coach is something where they will look at your whole picture, but then you can say, well, I had $1,800 extra, and it was a little bit extra this month. So you can go back in, you can adjust that. So, and then they give you the best suggestions for that. So it's really kind of like calling a friend or mom or dad or a financial advisor or whoever it may be, where the everyday person can get suggestions for what they should be doing for this money. And it's really important to their future goals because of how they want the person to really experience SoFi. What should I do with this extra money? And that AI portion of it, I think it's a huge direction in the way that they want to go.
You've mentioned invest twice now.
Mm-hmm.
Just
Yep.
from a technology aspect, innovation, I know we've sort of critiqued the technology aspect of SoFi, continuously in terms of the rate of new releases, because we compare it with Galileo, who's releasing products left, right, and center. After seeing it from the inside, in terms of their appetite for risk, in terms of their appetite for new ideas, in terms of how innovative these ideas are, and also the pace of execution internally. Like, is there just a whole number of products that they've tested internally and said, okay, this isn't going to work, moved on to other ideas? Is there a whole number of irons in the fire that we just don't have access to because we're looking from the outside in? Or is it simply that, they're focused on a few core things and doing those core things well, and things just take time and we have to wait for them?
So I would say there's hundreds of irons in the fire. So for example, in one day, we might do breakouts and come up with 12 ideas. And then we pitch those ideas. And then out of those 12, one will be chosen. And then it goes back to people way above my pay grade. Then they look at that one, and you do that day after day after day. So if it's 12 different things a day, and then at the end of the week, they have 7, and then they pick one. This is something I'm just guessing. They're trying to do what they can within a parameter of not just bringing on a ton of IT, not just getting bloated in expenses and people and getting more space. Space is an issue as well. There's tons of ideas out there, but they're just lining them up. There's decades of ideas just lined up, and they're not going to just start throwing stuff out there. The biggest fault with SoFi is they analyze the product to death and they make sure that it's perfect. And they make sure that this is something they want to put out there. They look around where we are. And I think, everyone wants this invest stuff and they get very frustrated. They're more interested in getting this AI thing with the cash coach thing right. That's the direction that they want to go. And it's like, you need to understand that is the way they're going to go. When they say get your money right, they're not changing it to we want to beat Robinhood. And we talk about Robinhood a lot down there. Some of those people are just not people that they want. Some of the people are. Their focus is really more on coaching the general public, the John Q and Jane Qs. They just find that much more important.
Do you guys talk about the exact demographic that you guys are looking at, or is it getting so broad now?
They don't really talk about an exact demographic because there's so many people out there that don't know what they need. You're going to do a focus group on females between the ages of 24 and 27. The group that I'm in, it is a very diverse group. It's a very diverse company, and it's from retirees to people that just got out of college, and they want to know about everybody and everything in between. You don't have to be 24 to know nothing about money. You can be 45, you can be 55. The education part, he has no interest in, say, these Robinhood fanatics that are day trading and throwing money into crypto for a couple of days. They have no interest in that. They are looking for the individual, regardless of age, race, whatever. Any person that wants to, I hate to say it, get their money right.
I think one of the downfalls of surveys is that people don't always know what they want. They'll say they want something, and then they don't actually know until they have the option. One of my other bigger holdings is Duolingo, and they are consistently A/B testing everything in the app all the time, and so that they can then optimize. Then they see what the actual users do rather than what they say they're going to do. And I've gotten, countless surveys from SoFi. Have they looked at all at doing kind of A/B testing on different products and different age groups, that sort of thing? How malleable is it from that standpoint, or is it still kind of that same? They want to get it really right before they push it out.
Well, when you talk about surveys, I think the way SoFi does it, they actually interview people kind of like what they did with me, and they have different groups. Mine is more of a member board, but I know that they have other groups, and so they bring people in and they give them the beta and they let them play with it. They bring the engineers right in with them and they go through all of these potential products. So they're not just sending something out and saying, what do you think of this? They're having people, like, they'll either send it to you, they will fly you in. The engineers come right in. You put together big boards of everything that you see. I've been in groups with 60-year-old grandmas from inner city Chicago, hip dudes and gals from New York, and they just try and run the gamut. But when you call it a focus group, they really focus on that group. They're not going to go with the shotgun approach and just ask you 10 questions because, when they send something out, it's always somebody who has a problem with something who makes the suggestion. They want to get their target audience and they want to whittle it down to people who can speak to it. They do a lot of it, I guess you'd say, more internal. I've never had a conversation with Noto other than, can I have your picture? Here, I thought I could get him on Tanner's channel. So last time I was down there, I was like, oh shit, that's not going to happen. He has so many handlers around him and so many assistants and all that I couldn't get to it. But
I wanted to ask Matt, just because you brought it up, on trying to get Noto on Tanner's pod. Just this segment has been probably one of the most, if not the most insightful. I don't know. I geek out on the tech aspect and the testing aspect. I don't think you've disclosed anything that you weren't allowed to disclose. It's just how the sausage is made, essentially. Just your opinion, your gut. Like, where do you think that reluctance comes from management side to interact with retail? I mean, Tannor just had Vlad on his show weeks ago, and he's talked about product. He's talked about their approach to testing. He's talked about stuff that makes him excited, the vision, whatnot. And we sort of have to get that piecemeal from CNBC or Bloomberg. Is it some compliance? Is it some regulatory thing, do you think? Or is it some other I'm just curious to get your thoughts.
And it's my understanding, like Scotia said, they are aware of the SoFi Weekly, correct?
Absolutely. Yep. They know all your names. They know all of you. I guess to answer the question, I don't think people understand how big SoFi is and how important Anthony Noto is. And it's like they're so busy and he has so many people lined up outside his office person after person. His day, his month, his week, his year is booked. He doesn't have time. I kind of put it in the camp of, does Tannor think that he's going to get Jamie Dimon on his show? Because that's where Mr. Noto is coming from. Like, this is not Vlad. This is not a toy. Vlad was kind of he engineered and worked on a lot of that stuff. Mr. Noto was brought in to build this company and, as he said, to be a top 10 institution. It's not a joke. And he's so busy with everything else. There's just no way something like this would be put on a calendar. Go get Jamie Dimon instead. Go get Brian Moynihan. But at the same time, I mean, we've brought it up, especially my buddy Chris, who's on the board too. We've brought up all the names and they know the names.
Yeah.
So just the fact that they're aware of you guys and fully aware. There's a whole department that knows about you guys. So don't be sad if he doesn't. You
hear that, guys?
If he doesn't have time for you, but you are known.
You know what's funny is Robinhood is having a summit. I'm going and I'm like, no one's even gonna know me. If SoFi did a summit, I'd actually feel welcomed. I'd be like, I've made a weekly show about you guys. I'm sure there would at least be a handshake.
100%. I mean, it would be great, to get you guys into the office. It'd be hilarious because everyone would probably, they would know more about you than you would know about them. So you guys are known. But it's serious down there. When you go into the offices, it's they're eating their lunch at their computers. They come in early and they stay late, and they work hard. There's no ping pong tables. There's no pool tables. It's a very nice office, but they're working hard. Yeah, so you guys are definitely known.
We barely spoke about lending. Like, do you guys have conversations about personal loans or credit cards or these sort of things and how those products might benefit certain users?
Credit cards are on the front.
So it's financial services that you're covering.
Yeah, and mostly like the lending. I don't want to say autopilot. The lending, they have, the mortgages are set up. They don't have any more questions about that. Personal loans, student loans, those are just a machine. I would say the lending is just automatic. That's the heart of SoFi, and they don't have any questions about that. They don't need to ask anybody how to make a student loan. They're going to adjust their rates. They're going to make their sales. They're going to, contact. And that's another thing is that, once you have a good contact, when they make their sales, they're not just going to sell willy-nilly. So they're, once they have those clients, those are the first ones that they go to.
Can you settle a bet for us? There was some conversation about the SoFi Plus subscription product. Do you have any insight on this?
A little bit. What's your question?
Is it a new product or is it just for non-direct deposit users?
It's a little bit of both, actually. So it's because they're gonna the SoFi Plus is gonna come out along with some different credit cards, and so they're gonna make a little bit of a shift in products. But yeah, pretty much it's gonna be a subscription. They're looking at, if you don't have your direct deposit, you can pay this, or you can deposit X amount per month. And then they've looked at having 3 different tiers, is all I know, is what we're discussing.
Do you think that as people at SoFi see this episode air, how do you think they would feel about the stuff that you've shared? Do you think they'd be like, Matt, why are you sharing that?
I think so. I think that I've probably said more than they would want. They're very much heads down into their work. Anytime you say something before it happens, it can change the day before it comes out. So I could say something now and then the whole product could change once they take that feedback and go back and do it again. So yeah, they'd probably think I'm an idiot.
I think you've spoken very highly of them, and I don't think you're holding them to any sort of product deadline or anything like that. So ladies and gentlemen, thank you all so much for watching. We're going to take this into the SoFi After Hours show.